Through the years, private markets have offered a very simple trade-off. In exchange for less liquidity, investors have consistently achieved better risk-adjusted returns. Now let's look at why this is and try to understand how much returns are typically enhanced and how much liquidity is typically constrained. When looking at historical performance, private markets have generally delivered returns higher than public strategies, often with less risk. As a result, people are attracted to them. This outperformance is really explained by two factors. First, there are structural advantages. Private companies have lower legal costs and fewer administrative burdens. They also have fewer disclosure requirements. And maybe the most important thing is that private companies aren't beholden to public shareholders, so they don't have short-term pressure that might otherwise impact their decision-making. In turn, that allows private companies to focus on long-term growth and value creation. A major trend in capital markets over the past few years has been to take public companies private. Second, private companies are typically acquired at lower valuations than their public counterparts. This is usually because there's a very limited number of bidders involved, but it's also because private companies tend to remain private even after they gain scale. The flip side of that discussion is that there are some weaknesses associated with public securities that are seldom discussed. First, as many viewers of this channel will know, public markets are highly efficient, making it difficult to outperform through security selection. The second drawback of public offerings is that easy liquidity leads to frequent trading, and frequent trading leads to poor performance, higher transaction costs, and higher tax bills. Finally, public stock markets can be extremely concentrated. We only need to look at the rise of the so-called Magnificent Seven stocks in 2025 to understand concentration risk. The liquidity risk premium is usually defined as the additional return investors demand for holding assets that are less liquid, compensating them for the risks associated with the difficulty of buying or selling those assets quickly and at fair market prices. This premium exists because illiquid assets are thought to carry more risk. Investors may face challenges in selling these assets quickly. In short, investors demand higher returns from illiquid assets due to greater selling difficulty. Now let's look at this from both sides. What are the pros and what are the cons? As I said earlier, the big win here is better risk-adjusted returns. Not only are correlations lower for private companies, they typically earn 10% to 40% higher returns to private versions of the same asset class. Let's split the difference and assume that the return premium is 25% in exchange for less liquidity. Adding 25% to your expected return means that something that earns 4% might earn 5% as a private alternative. A public asset class that earns 6% might earn 7.5% as a private holding, and an asset class that earns 8% available publicly might earn 10% privately. In a world where outside returns are increasingly hard to find, private markets offer an untapped source of performance lift. Now, let's turn to the downside. Unlike stocks, bonds, mutual funds, and exchange-traded funds that can be sold in 24 hours, private offerings typically take about 3 months to gain liquidity. If you put a sell order in November, you might not get your money out until the end of February. To me, this is a modest drawback. It's more of an inconvenience that can and should be planned around. Look at it this way. How many people do you know that own their own home? Lots, right? Now, has that home been a good investment? Would you buy a home now if you didn't already own one? Would you expect it to be a good investment down the road? Most people would answer yes to all of those questions. Now, if you wanted to sell your home and get your money out and into your jeans the next day, could you do it? Of course not. Does that illiquidity stop you from buying real estate? Most people have more equity tied up in their principal residence than they have in their investment portfolio. Besides, how many times have you heard finance people say, take a long-term view? How is it consistent with taking a long-term view if you can't even wait 90 days to get your money out? The one thing that's used most often as a criticism is the concept of gating. In my view, it's a feature, not a bug. In a traditional vehicle that holds publicly traded stocks, redemptions are relatively straightforward. When investors want their money back, the fund can sell some of its holdings, raise cash, and return it to the investors. Simple. In vehicles that hold illiquid assets, however, it's not that simple. If too many investors request trade redemptions at once, the manager may be forced to sell assets at unattractive prices. This erodes the fund's value and penalizes investors who remain invested, so redemptions are temporarily suspended. That's referred to as gating. Gating provisions exist to avoid exactly this scenario. They may last a number of months, but at the end of the day, even well-managed funds can invoke gates when too many investors line up for redemptions at the same time. Put another way, gating is a protective measure designed to prevent forced asset sales and maintain fairness among investors. The takeaway is clear. Gating risk can never be eliminated, only managed. That means aligning commitments with time horizons, diversifying liquidity sources, and avoiding investments with capital that might be needed in the short term. The smartest investors accept that liquidity in private markets comes with a cost, and they make sure they can afford it. If people have the lion's share of their money in assets that can be sold in 24 hours, gating is likely to be no more than an inconvenience. All told, private assets offer several benefits for retail investors. The limitations, while real, are relatively modest and, in my opinion, well worth it.